Hi, we're Sales Tax and More. Today, we will be discussing income tax for remote sellers. We are all well aware that due to temporary closings of offices and businesses and stay-at-home orders issued across the United States during the coronavirus pandemic, many businesses implemented temporary work-at-home options for employees. Many states announced temporary relief regarding a business's establishment of nexus solely because an employee is temporarily working in a different work location due to COVID-19. So now that in some ways the pandemic is over and there has been an adjustment period for businesses, remote employees are starting to create tax issues. States are moving to new and updated policies in regards to remote workers, sometimes having consequences. First, states are setting new timelines. This is a hot-button issue, and states are providing more clarity than in the past, and more people are aware. Employers have always had to worry, and now employees do too. For example, in Utah, the state legislature has approved a bill adopting provisions of the Multi-State Tax Commission's model legislation for taxing non-resident employees working temporarily in the state. The legislation would establish that non-resident employees must work in Utah for more than 20 days in a year before their wage income for work done in the state is subject to taxation. Not all employees would be eligible for the protection, including professional athletes, prominent individuals who provide services on a per-event basis, and higher-paid key employees of businesses, among others. The legislation also modifies the state's withholding rules so that employers obligated to withhold in the state don't withhold taxes on income paid to their employees in Utah who qualify for the safe harbor provided by the bill. Another example is in South Carolina. The temporary nexus and income tax withholding relief provided in 2020 to employers with workers temporarily working remotely because of COVID-19 is ending. South Carolina has also updated its guidance on income tax for residents, non-residents, and everything in between. Take note, a non-resident of South Carolina working in South Carolina for more than half of any pay period may be required to pay income tax in that state. This means if you are working remotely for a month in South Carolina on the warm beach, you are now subject to income tax. Something that is important to take into consideration in all states is the impact these changes and updates will have on employees who regularly travel for work, those traveling, and whose income exceeds the sometimes lower than expected wage threshold, like $130,000 in Utah, and those who are traveling while working as a perk. Next is cost versus the MTC. There are two groups that have released guidance and who advocate for their general guidance to be followed within the states when it comes to income tax nexus. The Council on State Taxation generally advocates more on behalf of businesses, and the Multi-State Tax Commission more on behalf of states. Before we talk cost versus MTC, it's important to note that even if states are not following either of these models, they are coming up with guidance for residents, non-residents, and everything in between. This impacts employers and workers. States have also provided other forms of relief by establishing reporting thresholds. Roughly half of the states currently provide a minimum day threshold averaging around 15 workdays before wages are subject to income tax or withholding. Of the states that do not have a minimum day threshold, most have a minimum dollar threshold for the portion of wages earned while in the state, which is often tied to the state's personal exemption. Finally, here are some generalized comparisons between the MTC and cost guidance. The Multi-State Tax Commission guidance is state-focused. There is a 20-day threshold. It includes similar exceptions as cost, like athletes, and the MTC proposal also has a high wage exception to the days worked threshold for any employee whose total annual wages exceed an amount as determined by each legislature. The amount would generally be calculated based on the prior year's wages. The cost guidance, on the other hand, is business-focused. There is a 30-day threshold, and it has similar exclusions to MTC. Illinois, Louisiana, and West Virginia have adopted the cost model legislation. You may have heard or seen us say that income tax will be the next big battle for e-commerce sellers. While this isn't the full story of why that is, these changes are a factor of it. If you have any questions about this or anything related to sales tax, let us know. We'd be happy to help. Thanks for watching.